Hello and welcome to the Finance Quarter. I'm Andrew Robertson. On the program today, protecting our money. Should balanced investment funds really be balanced? And doing a good job while the CEO may still get the sack anyway. But first to climate change. And federal Labor needs no reminding that one of the key reasons it's in minority government is because it walked away from what Kevin Rudd described as the greatest moral, economic and environmental challenge of our generation. The Australian people want action on climate change, and with the election out of the way, the business community is also stepping up the pressure, with BHP Billiton boss Marius Kloppers saying the clock is ticking. Federal Labor has just paid a heavy political price for backing down on its 2007 election commitment to tackle climate change. BHP's Marius Kloppers believes Australia will pay a heavy economic price unless decisive action is taken soon.
A global initiative will eventually come. And we do believe that when it does come, Australia will have needed to act ahead of it coming in order to maintain its competitiveness.
Mr. Kloppers believes the fight against climate change must start at a local level, slowly expanding to the global initiative he talks about. In Australia's case, he cites the heavy dependence on coal for power and says it's time to look beyond coal to other sources of energy.
We need to anticipate a global price for carbon when we take decisions with long-dated impact. The decisions we take now on power production will still be with us long after a global price for carbon is finally in place.
In Australia's reshaped political climate, the newly powerful Greens will be pushing hard for big targets to reduce carbon emissions through a variety of market mechanisms, a point Mr. Kloppers seems to be in agreement with. It's a task he concedes will take courage from politicians.
No government relishes telling consumers that things need to cost more. Through higher and more expensive standards, so double and triple glazing, and through higher fuel and energy costs. But in this case, there really is no easy answer. All of us who care about this issue need to recognize that making a difference comes at a price, and it cannot be glossed over.
Not surprisingly for the head of Australia's biggest exporter, Mr. Kloppers also believes trade-exposed industries should have emissions costs rebated until all their competitors are operating in a world of carbon pricing. If they don't, he's concerned BHP Billiton will become uncompetitive. He also points out that heavy polluting industries will gravitate to the countries with the most carbon-friendly regimes with no net reduction in pollution. Most of us have our superannuation in what's quaintly known as a balanced fund. These funds are meant to offer a trade-off between risky assets such as shares on one hand and defensive assets like cash and bonds on the other hand. In reality, those so-called balanced funds often contain 60, 70 or 80% shares. And in the post-GFC world, there are increasing calls for balance to really mean balanced. One of the people leading those calls is a director at FIIG Securities, Steve Nash. And Steve, why is it that Australian investment funds have such a heavy weighting towards shares?
Well, according to OECD figures, pension plans have a very high allocation in Australia. I think there's a variety of reasons. I think one is the tax system. As the Henry report indicated, the taxation of equities is much lower than less risky assets like bonds. I think there's also the perception that equities have better returns, or what we call the term growth assets, and those returns have conditioned people to accept higher levels of equity allocation.
So the heavy losses we saw during the GFC, is that just an outworking of that old investing paradigm that the higher the return, the higher the risk?
Well, I think if you look at equities broadly, there is a perception that risk is only a periodic event in equities and that it's short-term in nature. But over time, you can see that the risk of equities is almost double the return. It's a very permanent feature of equity investing. I think the sales pitch that you typically hear is that there's all return and there's little risk, but in fact, it's the opposite, where the risk is much higher than return.
So the heavy losses we saw during the GFC, is that just an outworking of that old investing paradigm that the higher the return, the higher the risk?
Yes, if you look at various combinations of equities and bonds over the last few years, you can see that allocations of over 50% to equities in the 2009 period would have resulted in greater than a 20% annualised loss. Also, if you look at the risk-return aspects of equities and bonds, when you combined equities with bonds, something around 50% tends to equate the risk and return characteristics. So what we're arguing is that bonds should be at least 50% of your portfolio, or risky assets should be around that 50% mark, not up to 75%, as seems to be the case.
Under your hypothesis, are you saying that to protect our money in the bad times, the returns in the good times are going to be less?
Yes, I think so. In the good times, obviously, if you have more bonds, your returns will be slightly lower than with equities. But what you'll find is the big advantages of having more bonds is that your risk will be a lot less, substantially less. We've done simulations with various mixes of equities and bonds, and we find generally that by adopting bond portfolios, you can trim your return by about 15-20%, but your risk is more than halved. So you get the benefit on the risk side.
Now, you're a bond specialist, so you have a vested interest in promoting bonds. Why should viewers not take what you say with a grain of salt?
Well, if you look globally, bonds are very well accepted in the developed world, particularly in Europe and Germany. Allocations to bonds are up to 60%. Here in Australia, allocations, particularly for the retail sector, are in the 2-3%. What we're trying to do is, I suppose, make people aware that they are underweight bonds, and there is a really big role for bonds in retail portfolios.
Stephen Nash, a lot for our viewers to think about. Thank you very much for your time.
Thanks very much.
The chief executives of many of the big companies listed here at the Australian Securities Exchange often hit the headlines over their big salaries. But with those big salaries come big risks. And one of the biggest is that even if they do a great job, they could still be sacked, as we saw recently when Leighton Holdings announced the departure of its veteran CEO, Wal King. He's the latest in an increasingly long line of well-performed bosses to be shown the door through factors outside their control. Graham Bradley is now the face of the Business Council of Australia, but for 8 years until late 2003 he was the chief executive of financial services company Perpetual.
My understanding is with Perpetual, Graham Bradley, who did an extremely good job as managing director, was focused on the business domestically and wanted to keep it as a domestic business, and the board wanted to expand internationally. And that's when they brought on David Deverill.
Mr Bradley was a victim of one of the risks that all chief executives face, in that their view of the future may differ from their boards.
It really does depend on what the company needs at any one particular time.
Anne-Marie Moody advises company boards on strategy issues and points to the ANZ Bank's change of chief executive 3 years ago as another example of a good chief executive losing his job.
The company is looking over a period of time of 5 or even to 10 years, that you have to consider whether that CEO you have in at year one is going to see you through the whole strategy. And they may well do that, but it also may mean that if you want to stick to that particular strategy, that you need maybe 2 or even 3 leaders to take you through that full length.
ANZ wanted to push harder into Asia, so it replaced long-time successful chief executive John McFarlane with current boss Mike Smith, a man with extensive experience in the Asian region. Of course, it's the board's job to set the company's direction, and chief executives who try to usurp that role can also find themselves shown the door very quickly. When BHP Billiton was formed from the merger of Australia's BHP and London-listed Billiton, Billiton's Brian Gilbertson was appointed to run the merged company. He was sacked almost as quickly as he arrived.
It was a case of the CEO and the board wanting to pursue different strategies, so there had to be a parting of ways, and it was quite brutal, but it was effective, and what was put in place at BHP was a very considered succession planning process.
It goes with the territory for chief executives that factors outside their control can see them out of a job. What they can control, though, is their own performance, and a good performance of consistently delivering for shareholders is still the best way to have a chance of long-term survival. A man who's now been in his job longer than the average CEO tenure of 4 years is Wesfarmers boss Richard Goyder.
One of the things that I constantly challenged myself about is, are you contemporary in your thinking? Are you're thinking now in 2010, not back where you were in 2005? And I think, being contemporary is really important.
While he's hoping to remain CEO of Wesfarmers for some time to come, Mr Goyder concedes he may be asked to go if the Wesfarmers board decides someone else can bring more value to the company than he can. Well, if you can survive all those machinations in the boardroom, now is a great time to be running a mining company. And the reason, of course, is China's insatiable demand for Australia's natural resources. It's a demand, though, that can be hard to understand so far away here in Australia from where all that coal and iron ore is being used. But to help us understand, Reserve Bank Assistant Governor Philip Lowe has revealed some incredible statistics about the biggest migration to urban living in human history.
Over the past 30 years, nearly 400 million Chinese citizens, that's almost 20 times the current population of Australia, have moved to the cities. As a result, there are now around 170 Chinese cities with more than 1 million residents. In Europe, the equivalent number is just 35. And this process of urbanisation in China has still a long way to run. Most estimates suggest that in the next 20 to 30 years, another 300 to 400 million people will move from the country to the city.
And a huge amount of iron ore and coal will be needed to make the steel to build all those Chinese cities. And as well, India is stepping up its modernisation program. So what that means is Australia's resources boom still has a long, long way to go. Now, we'd love to hear your thoughts on the program, as well as questions around money and business and suggestions for topics we can cover. Our email address is thefinancequarter@your.abc.net.au. If you'd like to see any part of the program again, you can find us on the ABC News website. Just go to the business page and click on the Finance Quarter icon. Thank you for watching, and we'll see you next time on the Finance Quarter.